We are covering rental real estate income and expenses, which are reported on Schedule E. The exam will test your ability to correctly identify what constitutes gross rental income. This includes not just the monthly rent checks but also trickier items. For instance, advance rent is always income in the year it is received, no matter what period it covers. If a tenant pays you in December 2024 for their January 2025 rent, you must report that income on your 2024 tax return. Another common trap is security deposits. A security deposit is not income when you receive it if you plan to return it to the tenant. It only becomes income if and when you keep part or all of it to cover damages or as a final rent payment. Similarly, payments received for canceling a lease are considered rental income in the year they are received. On the expense side, you can deduct ordinary and necessary expenses like mortgage interest, property taxes, insurance, and repairs. The exam loves to test the difference between a deductible repair, like fixing a leak, versus a capital improvement, like replacing an entire roof, which must be depreciated over time. Now, for the most heavily tested area, which is the passive activity loss limitations. By default, the IRS considers all rental real estate activities to be passive, even if you are heavily involved. This means if your rental expenses exceed your rental income, you have a passive loss. The general rule is that you cannot deduct passive losses against your active income, like wages, or your portfolio income, like interest and dividends. Instead, these losses are suspended and carried forward to future years to offset future passive income. However, there is a major exception called the active participation exception. This is a critical concept for the exam. If you are an active participant in the rental activity, you may be able to deduct up to $25,000 of your rental losses against your non-passive income. To be an active participant, you must own at least a 10% interest in the property and make significant management decisions, such as approving new tenants, setting rental terms, and approving repairs. This is a much lower bar than material participation. The trickiest part of this exception, and a favorite exam question format, is the income limitation. This $25,000 allowance is phased out for taxpayers with a modified adjusted gross income, or MAGI, between $100,000 and $150,000. The allowance is reduced by 50 cents for every dollar your MAGI is over $100,000. For example, if your MAGI is $130,000, you are $30,000 over the threshold. Your $25,000 maximum loss is reduced by half of that, or $15,000. This leaves you with a maximum deductible loss of only $10,000. A simple way to remember this is the mnemonic. At 150, the 25 is history. Once your MAGI hits $150,000, the entire $25,000 special allowance is completely gone. Be prepared for questions that give you a loss amount and a MAGI and ask you to calculate the deductible portion. They are checking if you know both the $25,000 limit and the MAGI phase-out rule.